Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Randy Frederick. He is the Vice President of Trading and Derivatives at the Schwab Center for Financial Research. We're going to take a look at the options market, and did it signal the volatility that we're seeing in the markets right now? Randy, it's great to have you back with me as always. And option market could have seen something coming even as we were rallying to all-time highs.
It did to some extent. I mean, we didn't know exactly what would happen. I think this coronavirus outbreak is probably the most classic example of a black swan event that you could come up with, because who knew where it would hit, when it would hit, if it would hit, how it would impact things? Nobody knew. A lot of the events that cause volatility in the markets, like an elections, an earnings report, a Fed meeting, those are all things that are on the calendar, but a black swan event just completely comes out of nowhere, which is what happened here. So what we saw in the options markets were not things that caused this kind of a decline to happen, but there are things that tell us that people are very, very vulnerable so that when we do have an exogenous event that surprises the markets, that people are going to get hurt, and this is what's happened. So we saw things like option volumes really getting to record levels, which is very unusual in a bull market. You typically don't see those big volumes until you get a pullback like we're experiencing now.
Yeah, there was just such a level of complacency in the market to see how its resilience is being tested, something we haven't experienced. I mean, even today, it's Wednesday, February 26th, up 320 points, then down 150 points. Right. The swings are so extreme because you have algos reading these headlines, and 1 minute the disease is under control, the next minute it's not, and then we're seeing new cases pop up. It's might be good for traders, but it's got to rattle investors a bit.
Yeah, and I think this is important because I sent out a message over Twitter yesterday and the day before and again today that remind people that volatility is not directional. It means big moves in both directions, and we, like you just said, have experienced both of those, both that today. In fact, some of the largest up days that you'll find are in really bearish markets. If you go back to 2008, 2009, we had massive sell-offs. We had giant up days throughout those periods of time, and that just sort of speaks to the volatility. People get very sensitive to news, and then they react one way or the other. And I mean, even before markets opened, the futures markets were like a yo-yo, and now we've seen it since the markets have been opened as well.
I think the market is trying to figure out, what does this look like in terms of the supply chain? What's that shock really going to be? We understand it might impact a couple of quarters, that's fine, but consumer spend was really the story for 2019. If conferences aren't taking place, if people are going to be cautious and not go out to dinner or the movies, and the service sector gets impacted, that's money that typically goes back into the economy. And I think we're trying to discern what that's going to look like.
Right. So there's a lot to that statement. So first of all, in developed markets, for the most case, and the United States is no exception, about 70% of GDP is driven by consumer spending. How it actually impacts the economy has to do with what type of a product or service you're talking about. If you were going to buy a new cell phone and you can't go out because of either the store's been closed or the manufacturer who produces that phone is no longer building it because of restrictions, then you'll probably just wait and go out next month and buy that phone then. On the other hand, if you wanted to go out to dinner with your spouse on Wednesday, but the restaurant's closed because of a quarantine, that doesn't mean you're going to go out twice next week. And so I always say you need to divide things into consumables and durables. If they're consumables, chances are that revenue that's lost is lost and it's not coming back. If it's a durable, chances are that any revenue that's lost in, say, Q1 can be made up for in Q2 or Q3. If you need a new car, the fact that you wait an extra month or two doesn't mean you don't need a new car any longer. You're still going to have to get that new car eventually. But on the other hand, if you're talking about taking a vacation, staying at a hotel room, going to a casino, eating out at a restaurant, all of those things that you don't do are just lost, and they don't come back.
Yeah. Politics. Always fun to talk about. Has that been priced into the market yet? You could argue the healthcare sector with Sanders as the front runner could see some pressure.
Yeah, I mean, if you go back to 2016, you'll see that the markets really didn't pay a lot of attention to what was going on in the politics until about the 1st of September. At that point, we had an uptick in volatility, which pretty much stayed with us until the election day. My expectation was that this year we would see similar things. You're right, if there's one sector that seems to have been impacted by this, and it's not just in 2020, this goes all the way back into 2019, an underperforming sector for a long time without any other explicable reason has been healthcare. And it happens to be one of the sectors that we have an outperform on, and we've had an outperform on it longer than any other, part of the reason being that it hasn't been driven to astronomically high valuations like some of the other sectors has.
Yeah.
And it may be a proper read, it may be a misread. I think that because of discussions about potentially lowering drug prices, putting caps on drug prices, allowing Medicare to negotiate drug prices, or things such as what Bernie Sanders has proposed, which is universal health care, has caused a lot of people to create to have uncertainty about the healthcare sector, and so therefore they've sort of had hands off. But that's made it a favorable looking sector for that reason. But I'm not sure that that necessarily is true. I think to do that, you have to kind of slice down into the industries within healthcare. So for example, we know that people are getting older. We have aging demographics. That's not going to change anytime in the next decade. If you even were able to, say, have a Bernie Sanders get elected, and you, say, for example, were to switch the Senate over to Democrat and the House remains Democrat, they might have a possibility of getting universal health care through. And if that happened, the only one of the industries within the healthcare sector that would maybe get clobbered would be the health insurance industry. But I don't know that it would necessarily be bad for pharmaceuticals, for biotechs, for hospital management companies, for any doctors. All of them would frankly just have more business. So I don't know that it's necessarily a proper read. I think it's an assumption. And then even in that case, again, it's still a long shot that it could happen. Getting something like that through, which is a fundamental change in how we do healthcare in this country, that would be a major, major undertaking, and it would be difficult to do.
You know, when you think of Schwab, you think of retail investors. You have such a huge base of clients. As a retail investor, we don't get to watch the news all day long like you and I do. We're in finance, but you come home, you turn on the 5, 6 o'clock news, you see the headlines that we've already worked through our heads with what the FDA and CDC are saying. Then you take a look at what's happened in the market, and Dow's down 2,000 points up between Monday and Tuesday. How are they processing it? What are you hearing from Schwab clients? Are they staying long and invested?
They are, and at least from what we know so far. I mean, it's only been a couple of days, so it's difficult to get a good read on them. But what we do know is that over the last 4.5 months, really since about October the 11th of last year, which was the day that President Trump announced that Phase 1 trade deal with China was imminent. It didn't get signed until January, as we know. But from that day forward, from October 11th forward, the markets have been irrationally bullish. They really have. I mean, the market has just been going straight up at a 45-degree angle with very few pullbacks, even minuscule 1.5% pullbacks. So it was almost, I mean, I don't mean to be insulting about it, but it was a stubborn bullishness to some extent, because whenever I or anyone else on the research team presented things that could potentially be problematic or that might cause some volatility in the market or that maybe require some caution, people just like, I don't want to hear it. I just don't want to hear it. I'm bullish. I don't care what you say. Well, unfortunately, that leads to irrational exuberance, to use Alan Greenspan's term, and as a result, we see things like volumes going crazy. We see extremely low put-call ratios in the equities market, which has a very large retail component, as you know, and people not even just being bullish and using spreads where they'll often sell off the upside, and just try to capture the first few points, but just buying long outright because they want to have unlimited upside. Unfortunately, what ends up happening then is when you do have an exogenous event like we had, then we see this major meltdown that we've had. And again, this doesn't cause it, but it causes people to be much more vulnerable and to get hurt worse when it happens. So I've been trying to warn people about this for the last several weeks, that when you see really low put-call ratios, when you see high long calls being opened and very low short calls being opened, that people are being irrationally bullish. And unfortunately, we know that at some point we're probably going to get a reversal. We just can't pinpoint it to the day. I wish we could. But here we are, and it's happened, unfortunately.
All right, Randy, great insight as always. Thanks for joining me at MarketSite. And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.